Oh, okay. So today we are going to continue with group account, which we started yesterday. When we started group account, we we started by creating a context, making you understand why group account. And I started from intercorporate investment. That's the reason why we have to prepare group account is because entities invest in another entity. And we looked at the reasons why they do that. And we said they do this investment via instruments, financial instruments, which could either be debt or equity instruments. And we narrowed our focus to equity instruments, which are majorly shares of another entity. And when you invest in equity, you can have these three types of investments. There is investment in subsidiary, investment in associates, and financial assets. Our focus here is investment in subsidiary and investment in associates because we have already looked at financial assets. And from my explanation yesterday, you can guess that this is where equity interests in another entity is above 50%. While investment in associates is where equity interests in another entity is between 20%, but less than 50%. While this, of course, we can say where it is, where equity interests in the investee is less than 20% from our discussions yesterday. These are the standards we use to learn group account, IFRS 3 on business combination, IFRS 10 on consolidated financial statements, IAS 27 on separate financial statement, IAS 28 on investment in associate and joint ventures. So I introduced investment in subsidiary. This type of investment arise where you acquire equity interest in an investee and your holding in that investee is above 50%. And this type of investment gives you control. And also, I mentioned that you can get control even if you don't have up to 50%. And we said control is where you have exposure or right to variable returns of an investee from your involvement with that investee and where you have the ability to affect those returns through your power over the investee. An element of control, there are three. From this definition, there are three elements of control. One is exposure or rights over the variable returns of an investee from involvement with the investee. Number two is power over the investee. And number three is ability to use the power to affect the variable returns of the investee. So in these three elements, all link them together is this power, because that power is what is that right that gives the investor the ability to direct the relevant activities of the investee. And this right can either be gotten directly by buying shares in the investee of above 50%, or indirectly where the investor can appoint, reappoint, or reassign key management personnel of the investee, or appoint, remove, or reassign entity that directs relevant activities of the investee. Can also direct the entity or the investee to enter into transactions in the favor of the investor, or can carry out other activities in line with any management contract that they have. So when an entity has an investment in a subsidiary, the investor is known as the parent entity, while the investee is known as the subsidiary entity. We looked at investment in associates. We said you have an investment in associates where you acquire equity interest in another entity and your holding is between 20% but less than 50%. This type of investment gives you significant influence over the investee. And I told you that it's possible to have significant influence even if your holding is less than 20%. And when we say significant influence, we are talking about your power to participate in the financial and operating policies of that investee. And this power can be obtained directly by having voting rights through your shares that you have in the company, which is 20% but less than 50%. Or it could be obtained indirectly when you can demonstrate the following, where you provide essential technical information to the investee, or where there is exchange of key management personnel between you and the investee, or where there is material transaction between you and the investee, or where you're represented on the board of directors, or where you participate in the financial and operating policies decision of the investee. Any of these can signify that you have significant influence. When you have an investment in associates, that investee becomes your associates. We call them associates. While we can simply call you an investor, we can still stick to parent and still call you a parent entity. How do you then account for investment in associates? We account for investment in associates by IFRS 10 requires that an investor must prepare consolidated financial statement. And this consolidated financial statement is the financial statement of the parent and its subsidiaries that is prepared as that of a single economic entity. Let's look as if we have prepared this statement for a single entity, where in actual sense is for more than one entity, that is the parent and its subsidiaries. In achieving this, we need to take note of the following. Number one is potential voting right. If there are any instruments that can become ordinary shares in the future, these instruments must be considered in determining whether an investor has control over the investing. You need to consider it, where there are potential voting rights, like call options or warrants or convertible bonds. These are potential voting rights. So examples of these potential voting rights are options, warrants, convertible debts. Now, IFRS 10 also allow exemption from preparing consolidated financial statements if any of the following exists. If the parent is itself an wholly owned subsidiary, meaning he himself has a parent, or is a partly owned subsidiary. He has a parent, but they are other owners. They are other owners. It's owned by multiple investors, but is a partly owned subsidiary, meaning he has other owners. And those other owners do not object to the parent not preparing consolidated financial statements. They are okay for him not preparing because they believe those people that have the majority holding will prepare. So that's one way in which it can be exempted. Also, if it's not a publicly listed entity, you don't have to bother preparing consolidated financial statement, or it's not even in the process of being listed. And ultimately, its ultimate parent entity will prepare consolidated financial statement. We also talked about exclusion of a subsidiary from consolidated financial statements, that when you're preparing consolidated financial statement as a parent, you must ensure you include all your subsidiaries. You want you to include all of them. The only condition where you can exclude a subsidiary from consolidated financial statement is when the parent loses control over the subsidiary. So the only singular condition where you can exclude the subsidiary is where control is lost. Other than that, you have to ensure you include all your subsidiaries in the consolidated financial statement. Another one is uniform accounting policies. Before you can prepare consolidated financial statements, the parent and the subsidiaries must have the same accounting policy. If those policies are different, it is expected that the subsidiary should align its accounting policy to that of the parent. We also talked about uniform reporting dates, where the reporting dates are not the same. You cannot consolidate unless the reporting date, the difference in the reporting date is not over 3 months. It's less than 3 months. It should not be more than 3 months. Is either 3 months or less. It's less than or equal to 3 months. However, even when the differences in reporting date is less than 3 months, yes, you can consolidate, but the parent must make sure that the subsidiary's account is adjusted for significant transaction in the books of the subsidiary. You have to adjust some major transactions that are indicative of events existing at the parent reporting date. Then we talked about parent separate financial statement. That yes, the parent prepares consolidated financial statement, but that does not preclude the parent from also preparing his own separate financial statement. And since he's the one that has spent a lot of money buying a subsidiary, he would of course account for that investment in his books, and you find it at cost. If it's an investment in subsidiary, it will be accounted for at cost in its books. But where a parent takes advantage of the exemption from preparing consolidated financial statements, if it doesn't present or prepare consolidated financial statements, then he needs to make some disclosure in his notes. He needs to make some disclosure in his notes. And what are the disclosures? Number one, he needs to state the fact that its financial statement is a separate financial statement and that he has taken advantage of the exemption from preparing consolidated financial statement. You must also state the name and country of incorporation of the parent entity that prepare the consolidated financial statement and the address where those consolidated financial statements can be obtained. You must also state the list of significant investments in subsidiaries, not only subsidiaries, even associates and joint ventures. And you must describe how those investments are accounted for. And finally, when we say group, when you hear me say a group, it refers to the parent and its subsidiaries. That's a group. When you have a consolidated financial statement, this is the content. The parent's own separate financial statements will be included, statement of financial position, statement of profit or loss, and other comprehensive income, statement of cash, consolidated statement of cash flows, and notes to the financial statement, including summary of significant accounting policies. Then we also explained the consolidation procedures, and we say we use consolidation method, which is quite very straightforward. And consolidation method involves canceling out items that appear as assets in the books of the parents with a similar item that appear as a liability or equity in the books of the subsidiary and vice versa. So basically, we want to cancel out similar item, then we combine or add together the remaining items that are not cancelled out. That's the whole idea. So majorly, the bulk of what we'll be learning, everything you want to learn is items that we cancel out. That's everything. It's just to cancel out. That is all. That is all. I can say that and say that over and over again. That is all. Because adding together is very straightforward. You find out that you just be adding together two figures at your level. But examples of items we have to cancel out is, you remember in the books of the parents, he would have recognized that investment in subsidiary at cost in his own books. And in the book of the subsidiary, that investment is represented by the equity of the subsidiary, because you must have bought shares in the subsidiary, which is the equity of the subsidiaries. So when you want to consolidate, those are the same items. Cancel them out. They are similar items. Additionally, when a parent buy goods from the subsidiary, you find out is you have a situation where one entity will have trade payables in his books and another will have receivables. They are the same item. Cancel them out. It's the same. It's arising from a single transaction among themselves. Cancel them out. And a lot more like that we're going to learn. But before we start solving, we looked at some illustration just to remind ourselves of those principles we learned. We looked at all this. Now, today, we want to then apply the consolidation method by canceling out and then combining any uncancelled out item. Now, I plan to solve as many questions as possible today. Then, if you have a calculator, just give us figures so that we can move fast. Then we'll cover a lot. Do you have Femi in class?
Yes, sir. Good evening, sir.
How are you doing today?
Good.
Okay, so can you read?
PICO acquire 100% of equity of ESCO since incorporation of ESCO on 31st December 2017. The statement of financial position of the two companies on 31st December 2017 are given below.
Okay,
Statement
okay, guys.
all figures are assumed correct. You are then required to prepare the consolidated statement of financial position of PICO at 31st December 2017.
Okay, good. So let's prepare consolidated statement of financial position. Now, from here now, we need to carefully observe the books of the statement of financial position of PICO and ESCO. And majorly, when you want to prepare consolidated financial statement, you need to first identify which items needs to be cancelled out. And the first one you need to get used to is the investment in ESCO, which is 60,000. That will be cancelled out against the equity of the subsidiary ESCO. You will see equity, by now you should know that is share capital and reserves, share premium and retained earnings. So it will be cancelled out against this 60. And as soon as we cancel that out, from here, those are the only items that can be cancelled out. There are no other similar items. You see, if there are other similar items, it's either you are told or you will see it, they will specify it. Like this one, if they are just written investments, it will be wrong for you to assume that this is investment in ESCO. Because if they just write investments, It could be any investment. So it will be difficult. So in exam, they will tell you that this transaction was with our subsidiary. Then you know that that needs to be cancelled out because they are the same. They are just mirroring one another. So we'll need to cancel that out. And that's the only item that we need to cancel out here. So we are preparing account for Pico, and we are preparing its consolidated statement of financial position as at 31st December 2017. So I will have my currency unit here. So I will have my assets and non-current assets here. Then I'll pick those items one by one. The first one is PPE. Help me add 320 plus 62,500. Anybody?
382,500.
Okay. 382,500. Then this investment in ESCO, it's perfectly cancelled out with this equity. So you don't even need to show workings. If you want, you can show your workings, but it's not necessary here because there's nothing serious around there. But even if I want to finish them, I can just show my workings. Say workings 1. So what do we call it? Well, now let me call it the consolidation. You can say consideration transferred. How much was the consideration transferred? 60,000. I'll compare it with the equity, or usually we call it net asset acquired. Net asset acquired, which is basically the equity of the subsidiary. And this equity will usually comprise ordinary shares. How much is the ordinary shares? 40,000 plus
Premium
share
10,000.
2,000. And 2,000. So they give us how much?
60,000.
60,000. So it completely cancels out. It completely cancels out. So no issue around that. And the others need to be added together. So having cancelled out those ones, then my current assets, 70 plus 10,000 is 80,000. 80,000. Then I have my total assets. What's the addition of this?
462,500.
462,500.
462,500. Then that should align with my equity and liabilities. Equity and liabilities. First, I'll have my ordinary share capital. What's my ordinary share capital that will be consolidated?
100,000.
Why are you not adding the two together?
No. You have said we have cancelled the
Because we've
40,000
cancelled
with the
1,000.
investment.
Fantastic. Fantastic. You're following. Then the share premium. What share premium are we consolidating?
Parent only, 125.
125,000.
Good, because we have cancelled out this, Abi.
Yes, sir.
Yes.
Good. Then retained earnings. We only have retained earnings for
75.
75,000. So what's the addition of this total equity here?
400,000.
Then we have our current liabilities. What's the addition of the two?
62,500.
62,500. So if you add it together, I have my
460,500.
total equity. 462,500. So the only thing we have done here is just to cancel out the only similar items that we have here. We only did just one cancellation, which is the investment in subsidiary against the equity of the subsidiary in the books of the subsidiary. Then every other item was consolidated, was added together. Let's move on to question 2.
So sorry, I noticed your working came before. Is this the standard for this particular consolidation?
That's the standard for every question I will solve for you in this class. I always do my workings before my statement. So it doesn't really matter here.
Okay,
So,
sir.
and that's what I would advise you to do as well in the exam. Don't leave space. You now leave space and go and walk at the back. You now be, no, that's not a smart way to do it because the examiner does not care. Just solve these things and move on. So do your workings, then do your statements in all of everything. And that's what I've been doing so far.
Okay, sir.
Now, Femi, let's do the next one.
Okay, sir. PICO regularly sells goods to its subsidiary company, ESCO, which it has owned since ESCO incorporation. The statement of financial position of the two companies on 31st December 2017 are given below. All figures assume correct. Okay. You are required to prepare the consolidated statement of financial position of PICO at 31st December 2017.
Okay. So our workings. We need to do some cancellation. And the one thing I know for sure you always cancel out is this investment in ESCO, which we bought for 20,000. We are going to cancel it out against the equity of the subsidiary, which is also 20,000. But the equity of the subsidiary is more than 20,000. There is retained earnings also, which is also an equity and is 9,500. So does that mean we're going to cancel out 20,000 against 29,500? No, you cannot. And that is where there's something important that we need to draw our attention to, which is something we call date of acquisition. Date of acquisition is the date you actually bought the subsidiary, and it is at that date that you pay this 20,000, and what you have paid for is the equity at that date. And the equity at that date, you don't expect the subsidiary to have retained earnings at the date of incorporation because you acquired this subsidiary since incorporation. And there's no possible way that you would have a retained earnings as at incorporation means when it started. So apparently, these retained earnings was after you acquired him. That was when he got these retained earnings. So that means this one is not part of the equity that we acquired. For that reason, we're not going to cancel it out. Not to worry, that's the principle that always apply, and they will always tell you the equity that you acquired. They always tell you because they will tell you the equity that was there when you acquired the subsidiary. So for this 95, it's not a similar item with this 20,000. It's not part of what we acquired. It's apparently only this 20,000. So I would have my consideration transferred, which is 20,000, against the net asset acquired, which is the equity of the subsidiary. And for my explanation, it's just the ordinary shares of the subsidiaries. And just 20,000, so they cancel out perfectly. Additionally, I can also see under current assets, there was a receivables and they wrote ESCO. That means I need to go to ESCO under liability. And luckily, there was payables, PICO. That means that needs to be cancelled out also. So this 1,000 needs to be cancelled out against this 1,000. We are not going to consolidate it. So in addition to this, also still under cancellation, we will cancel the receivables of ESCO, which is 1,000, against the payables of ESCO, which is also 1,000, needs to be cancelled out as well. Okay. And those are the only items that require cancellation here. So now I can go ahead and prepare my consolidated financial statements for PICO. So my consolidated statement of financial position as at year ended 31st December 2017. I will have assets, non-current assets. And the first item here is PPE, property, plant, and equipment. Can you help me add these two together?
40,000. 40,000.
40,000. Then the investment in associates has been cancelled out. We are not going to cancel out that.
Move to
Then our
inventories,
inventory,
14,000.
that's 14,000. Then the receivable, the one that relates to others. Receivables, others. That's 75. Then I can see cash at bank, which is just 500. So, how much was the total assets?
82.
Sorry?
22.
52. Okay. Then I will have my equity and liabilities. Then my equity. I will have my
Mr.
ordinary
60.
capital. Yes.
62.
Not 62.
60.
Okay, thank you. So my ordinary share capital, that
Parent
will be
only.
of the parent, because that of the subsidiary has been what?
So that
Cancelled out. Okay. Then retained earnings. How much are we consolidating?
17,500.
17,500 for retained earnings. So usually these retained earnings, we usually call it consolidated retained earnings. So let's just get used to that. Let's just call it that for them. Because you can decide to just call it retained earnings. Because why are they not calling all these other ones to consolidated inventory, consolidate? I believe it's tautology. But we are just used to that because a lot of items affect these retained earnings, a lot. So we just decided to give it that name. Otherwise, you are just fine. In practice, we call it retained earnings. We don't call it consolidated, but it's okay. Just leave it like that. Consolidated retained earnings. Then you go to current liabilities. We have bank overdrafts. But let's add this equity together first. How much is this?
52,500.
500.
Okay. So how much is the bank overdraft?
52,500.
All right, thank you. The bank overdraft, from what I can see here, I think is 1,500. Then we have our payables. Orders that we cancelled out
6,000.
is 6,000.
That's 62,000 total.
So what's the total? 52,000 plus 1,500 plus.
62,000.
2,000.
So our total equity in liabilities, 62,000. So here now, you see that we are gradually moving to more cancellations. In this question, the only difference between this one and last question is that we didn't only cancel consideration transferred against equity. We will also cancel receivables against payables. That's one. Number two, we now learned that The consideration transferred you cancelled out against the equity of the subsidiary is actually the equity of the subsidiary at the date of acquisition. At the date of acquisition. And that was why we could not cancel out that retained earnings, even though it is equity, but we cannot cancel it out because it was not an equity that we acquired. It was an equity that the subsidiary made after acquisition. So it's not similar to this 20, so we cannot possibly cancel it out. They are not the same thing. They are different transactions. We only cancel out similar transactions. So that's what you learned here for this particular question. Can you go to question 3, please?
The
Hello, sir.
statement of financial.
Yes, sir.
Hello, sir. Sorry, please. Can you help me explain this cancellation for payable and receivable?
There is no much explanation beyond their similar transactions. Is transaction between the subsidiary and parent. You cancel them out. So, and these receivables with ESCO 1,000, payables with PICO 1,000, the same thing, cancel them out.
Thank you,
I've
sir. Thank
explained.
you. Thank you, sir.
Okay. Okay, I can see your hand. Please go ahead.
I want to ask, based on this cancellation, are there situations whereby, like this one, it is clear, you see Pico and you see others. Are there situations where they will merge them together, then we have to do adjustments?
Sorry, can you come again, please?
I mean for the cancellation. Take for example this account payable and receivable. It is clearly stated Pico. Are there situations whereby we just have like a sum, then we have to do some adjustments to arrive in this case now? This is 1,000.
Yes, there might be some scenario. I didn't get your questions very well, but there might be some scenario where you have to do some adjustment when we get there. But as far as what I've explained so far, at least you understand it, right?
Yes, sir. Yes, sir.
Okay, so I'm sure if there are more complications, as you move on, you continue to see them. Okay, Femi, let's read the next one.
The statement of financial position of PICO and its subsidiaries, ESCO, have been made up to 30th of August 2017. PICO has owned all the ordinary share and 40% of the loan stock of ESCO since incorporation. The statement of financial position as at 30th of August 2017 is shown below.
Okay.
Okay. You are then required to prepare the consolidated statement of financial position of PICO at 31st of December 2017.
Okay. So for this one, I can see that in addition to buying equity, we also bought debt also. And we bought it since incorporation, since the guy started business. So that means in addition to canceling out this investment in ESCO, this 40,000 against the equity of ESCO, remember that this retained earnings of ESCO is retained earnings made after acquisition because we acquired the subsidiary since incorporation. So that's when it started up. So it cannot possibly have retained earnings. So this cannot be cancelled out. It's not the same transaction with this. So this 40, we only cancel out against this 40. But in addition to that, he also bought debt. He invested in debt of ESCO. He invested 10,000. And they were very specific in ESCO. That means this needs to be cancelled out against this debts, this 12% non-stock of 25,000. But that means that the total debt of the subsidiary is 25. That means out of this 25, we only bought 10. So we only cancel out 10. That means the remaining was bought by other people. That one is okay. As far as consolidated is concerned, similar transactions that give rise to assets on one side and liability on the other side needs to be cancelled out between the parent and the subsidiary. If it is with outsiders, that one is okay. Additionally, I can see another one. They have current account with ESCO. That means if I go to liability, I will see current account PICO. This also needs to be cancelled out. So I can see that we're going to cancel out 9,000 against 6,000. So there will be a balance somewhere here. There's going to be a balance for this. This balance here, what do we call it in this case? So when we say current account is an account that is used by members of a group or members of the same entity. Just please hold on. A current account. So a current account is an account used by entities within the same company, either departments, branches, companies, like in this case, group now. So this current account is what they use to record transactions they consummate between one another or among one another. So this goes to show that there has been transaction between the parent and the subsidiary to the tune of this amount. But the expectation is that the two amounts should be equal. They should always be equal. They should not be the same. They should always be equal. But in this case, they are not equal. So there are two things that can result to that. Two things. Number one is something we call goods in transit, which means that this parent is sent goods. Let's say he sent goods to the subsidiary, or he bought some goods from the subsidiary, but the goods have not arrived at the parent. There might be some differences, or it could be cash in transit, where the parent or the subsidiary sent money to one another and the other has not gotten it. That can result in difference. That is something in transit. So in the exam, they will usually tell us what is in transit, whether goods or cash. They will tell us. In this case, they did not tell us what is in transit. We were not informed. So since we were not informed, so for that reason, we can assume anything. And you will see that this guy is saying that, guy, I am owing you only 6,000. So in fact, no, yes, he's saying that I have a liability with you of I'm only owing you 6,000. This one is saying Mr. Subsidiary, you are owing me 9,000. Even though they are not speaking to one another, but apparently there is something in transit. This guy will have probably paid, so he has removed it from his liabilities, but this other guy has not gotten it back. So let's do those cancellations. Let's do those 3 cancellations. Number 1 is the consideration transferred in respect of the equity investment. How much did he pay? He paid 40,000.
40,000.
Yeah, 40K. Against the net asset acquired, which is the equity at the date of acquisition. And from here, it's just ordinary shares. It's just ordinary shares because this within earnings is after acquisition, because we acquired the subsidiary since incorporation. So the only equity that we actually acquired was 40. So there are similar items that needs to be cancelled out. So we cancel it out. We have a balance of 0. Then secondly, sorry, are you trying to say something? There's also a loan that was acquired. And for this loan, we paid 10,000. We paid 10,000. So the loan acquired in the books of the subsidiary, how much was it in the books of the subsidiary? The 12% loan, it was how much? It was 25,000 a year. So if I want to put everything here, there will be a balance of 15,000, which is loan acquired by outsiders. So you can go ahead and consolidate this one. You can go ahead and consolidate this one. So you consolidate this 15,000 because we only paid 10 and the total loan in the books of the subsidiary is 15, is 25, which means this remaining 15 is relating to outsiders. Then there was current account with ESCO of 9,000. And there is current account with PICO of how much?
6,000.
There is a balance that can either be goods in transit or cash in transit of 3,000. Because this is in transit, which means that it's not in their books yet. So it's outside. So you can still go ahead and
Stop making noises.
So you can still go ahead and consolidate for now because it is outside of the group. And from what I can see here, that is all we consolidate. Then, after our consolidation, we can go ahead and prepare our consolidated statement of financial position as at year ended, which period? 31st think I made a mistake here. This should be this 30th of August. Be this 30th of August, 2017. So we have assets, non-current assets. Then the first item here is PP. If you add the two together, that's 110. Then the next item, investment in shares, has been cancelled out. Investment in loan, it has been cancelled out. Then we can have current assets. Underneath that, we have inventories. The inventory addition is 55,000. So the inventory is how much? 55,000. After the inventories, we have receivables. And the receivable is how much? It's 35,000.
That's 35,000.
Okay. And after the receivables, this current account with ESCO, it was cancelled out, but there was a balance of how much?
3,000.
3,000.
There was a balance of 3,000, which we said we'll consolidate. So we called it cash in transit.
In transit.
3,000. It's outside, so we consolidate it. Then there is cash at bank. If you add the two together, we get 5,000. So we have cash at bank. It gives 5,000. And also, that's all. So if you add all this together, we get our total assets. So 110 plus 55, that is already 165 plus 35, that is already 200.
208.
Then 208. Then we'll have total equity and liabilities. You have equity. Under that, we have ordinary shares. How much is my ordinary shares? How much are we
50,000.
consolidating? 50,000. Again, I hope you still remember that we are not consolidating this because it has been cancelled out.
40,000.
So I have
If you
50,000.
come here again, I'll plug you. You sit down
Then
there, I'll plug you.
one, after that, is retained earnings. So we add these two together. What do we have?
61,500.
61,500. Then we have 10% loan stock. That's 37,500. That will come under non-current liabilities. How much did I call it again? 31,500. So what's my total equity? $101,500. And also, for this 37,500, not 31,500. Also, there is a 12% loan stock, which is 25. Remember, we have cancelled out how much from here?
10,000. We have balance of
10,000. 10,000. Then we have
Cancelled out
15,000 left.
meaning 15.
Yes, so that sum of that one is 111,500.
Okay, thank you, Seniors. And this
The other
one's
one is
supposed
37.
to be
Okay.
7. Then after this, I have my current liabilities. How much is my payables? Can you add this together? Should be 31,500, I guess.
1,500. It's 1,500.
Then we have taxation. What was the addition of these two? 12,500.
500.
Then we have current accounts PICO. This has been cancelled out already. So, oh, look at us. Oh. We omitted this. They told us.
Yeah, it's
Different
balance.
accounts because of goods in transit.
Yes. So
It's
don't let
goods.
us. They told us that it's goods in transit. So let's put it as goods in transit. Okay. So can we add all this together? Because we are done with everything. So 111,500 plus this, plus this, plus this, plus this.
Mm.
So how much is that?
208. 208.
208,000.
208,000. Okay. And that is all for this question. Now let's go to the next question.
PICO has owned 75% of share capital of ESCO since the date of ESCO incorporation. Statement of financial position as at 31st of December 2017. Assets, current liability. I should go through all of them. Okay. You are required to prepare the consolidated statement of financial position of PICO at 31st of December 2017.
Okay, so for this one now, something has changed there. Because now we only acquired 75% of the share capital of ESCO. And we acquired it since incorporation. So when we are canceling out, we can only cancel out to the tune of 75%. But the question is, that means there are other people that own 25%. Those other people that own 25%, we call them non-controlling interest. People that don't have control, since we are the one that have control. So the remaining people, we call them non-controlling interest. Now,
Interest.
IFRS 10 requires that when you are consolidating, you still need to recognize the value of those non-controlling interest in your books, because there's no way you can throw it. It's in the books of the subsidiary. So you just need to show it there that, okay, this equity of the subsidiary, it belongs to these people called non-controlling interest. And that means that this 15,000 that we paid, that we need to cancel out against this equity. That means you will see that, in fact, it cannot cancel out entirely because we did not acquire everything. We only acquired 75%. The remaining 25% is non-controlling interest. So let me show you how we deal with that. So in our solution, start with my workings. I will do my cancellation. I will have consideration transferred. We transferred 15,000. We transferred 15,000. We'll cancel that against the net assets acquired, which is the equity of the subsidiary, and that's ordinary shares. And the ordinary shares here is 20,000. So from what I've been teaching you so far, that means the balance, we'll call it what?
Controlling interest.
Uncontrolling interest of 5,000. But things can get more complicated, So the way we usually do it is we organize it in such a way that our workings, we will bring this non-controlling interest. We'll bring it here so that we are comparing 100% against 100%. So we have 20,000. So all we're trying to do, as far as this is concerned, is we're saying that, okay, yes, we know that the balance is non-controlling interest. We're going to cancel it out and all that. But we say that this is the investment we made, 75%. This is the portion that belongs to outsiders, which we did not acquire. So let's cancel it out against this. That is what is going to happen at the end of the day, ultimately. So I need you to get used to that very soon. You need you to get used to that very soon. So for now, this 20,000 would perfectly align and cancel out against this other 20,000 because they are similar items. They are similar items. However, you need to then respect these non-controlling interests. You need to assign, you need to recognize the fact that you have to consolidate it. You have to still recognize it in the books of the subsidiary when you are consolidating because it's still there. It's a value belonging to outsiders. So before I get there, I can see that I've cancelled out this and there is no other item here to cancel out. There's no other items here to cancel out. So like I mentioned earlier, you need to carefully acknowledge the fact that this non-controlling interest up here that we canceled out against these ordinary shares is a value, it is a portion of the equity of the subsidiary that belongs to outsiders. We need to show that in the consolidated account. So from what we have calculated, the value of the non-controlling interests up there was how much? Was 5,000. Now, so now, if you want to determine this 5,000, I moved it, when I determined my figure, I moved it from here. I said, no, don't let us see it as balancing figure. Let's come and put it here. So usually you find us that the way you calculate it is you get the portion, the percentage of the NCI, which is 25%. I know that because we only acquire 25%, multiplied by what they acquired, the equity of the subsidiary, which is 20,000. It will still give you the 5,000. So we cancel that out against so they perfectly cancel out. So this NCI here, I'm just putting it here so that you know and remember that it is a value that relates to outsiders. Additionally, is that when we are consolidating, we have always consolidated our retained earnings. And these retained earnings now of the subsidiary of 5,000, it doesn't belong to PICO alone anymore because PICO only acquired 75%. PICO only acquired 75%. So these retained earnings of the subsidiary belongs to PICO and the non-controlling interest. Belongs to PICO and the non-controlling interest. So PICO is going to have a share of retained earnings of the subsidiary, which is simply 25% times retained earnings of the subsidiary, which is 5,000. And 25% of 5,000 is how much?
75%.
1,250.
1,250. So that means the value of those NCI is actually 6,250. Additionally, the consolidated retained earnings of the parents is, we have the parent retained earnings. Let me say that of PICO. What was the parent retained earnings? 12,500. And we will have share of ESCO retained earnings, which is 75% times 5,000, which is how much?
3,750.
So what's the balance here?
16,250.
16,250. Now, I just intentionally structure it this way, just so that I have laid foundation on how our workings would actually go on. If not, I will have just done it the way we have been doing it, where I will just compare 15, I will cancel out 15,000 against 20,000. Then the remaining is NCI. Then that NCI, then since I know I will consolidate it, but you need to understand the meaning of NCI. That it means the portion of the equity of the subsidiary that belongs to outsiders. So that means that has to be consolidated. You should consolidate it. Since they are also part owners of the company, that means they also have rights to the variable returns of that subsidiary. And that's why they're also having a share of its retained earnings. So we share the retained earnings between this NCI and the parent. And that's why these other workings is coming up. If not, it will not come up. We will have just added the retained earnings together. Then I will prepare my statement of financial position. As at year ended 31st December 2017. I have my assets. I have my non-current assets. And for my workings, for my question, I have my PPE. If you add these two together, what does it give us? This should be 42,500, I guess. $42,500. Then the next item, which is investment in ESCO, this has been cancelled out. Then the next item is current assets. What's the addition of these two? So 500 plus
40,000.
40,000. 40,000.
Okay, that's 40,000. So we'll have a total assets of 82,500.
500.
Then we have equity and liabilities. We have equity. Under that, we have ordinary share capital. Our ordinary share capital will have 40,000 because this 20 has been cancelled out, even though there's a balance, but that balance will treat it separately. So B, what did we say we call the balance here again? Can you remind me?
NCS.
NCL.
I mean NCI.
NCL.
Non-controlling interest.
Good. So then the next item is consolidated retained earnings from the question. So we don't have to stress ourselves by doing 12,000 plus 75% of this because we already did the workings here. So 16,250. And the balance, the balance of this is still part of the equity of the subsidiary. So we'll put it as part of our equity, but we call it what? Non-controlling interest. We did the workings here. Now we got it as what? 6,250. So if you add all this together, what does it give us?
62,500.
62,500. Then we have current liabilities. This is 20,000 for our current liabilities. You add these two together, we have total equity and liabilities, which is how much?
82,500.
82,500. So everything ends there. So the only thing we are learning in this question is the fact that the parent only bought 75%. So we have NCI, and I've already set up a way to do the cancellation. Let's compare 100% with 100%. So we have 0, but we then set out NCI, extract its value, and add his own share of the retained earnings of ESCO, while the parent takes the remaining share of the retained earnings, then we consolidate. Still the same thing we have been doing, cancellation. So like I told you, and the thing is that for me, it gets extremely boring for me teaching this, because it's not just, it's easy, but it's just time consuming. A lot of simple things we need to, you just keep canceling, and that's all you will do. That's everything around this group account. So let's go to this next one. Femi, please read it.
PICO acquired the ordinary share of ESCO on 30th of June 2017, when the statement of financial position of each company were as follows. Statement of financial position as at 30th of June 2017. We have no current assets. Okay, you are required to prepare the consolidated statement of financial position of PICO at 30th of June 2017.
So thank you. So now, PICO acquired ordinary shares of ESCO on 30th June, and on the same date is preparing account. On the same date, he wants to consolidate, and the date he acquired them. Okay, that's fine. But how many shares did he acquire? He bought 25,000 shares. How many shares does the subsidiary has? 25,000. It means he acquired 100% of the subsidiary. Fine, that means in this question, no NCI. Good. So the only item we need to cancel out here is just this investment against the equity of the subsidiary. Let's go ahead. So our workings, we need to do some cancellation. Compare the consideration transferred. How much? 40,000. Cancel it out against the net assets acquired, which basically is the ordinary share capital of the subsidiary, which is how much? Which is 25,000. However, in this case, we are also going to cancel out retained earnings also of 5,000. We are also going to cancel out retained earnings of 5,000. Let me give you an opportunity to tell me, based on my explanation so far, why am I considering canceling out the retained earnings of the subsidiary this time around? Is there anybody that can tell me why?
I think it's because people acquired ESCO on the last dates while they are preparing their financial statements. So that retained earning must be what they have in the business before the acquisition.
Okay, that is correct, Semiat, because we acquired ESCO on the 30th of June, and this is the financial statement of ESCO at 30th of June. That means this retained earnings is a pre-acquisition retained earnings. Is pre-acquisition. It's there. We met it in their books. It's there. It's part of what we'll have acquired. So since we have to cancel out this investment against equity, but the equity is the equity that we acquired. Unlike the ones we have done, we have always acquired the subsidiary since the beginning. And that's why we never canceled out the retained earnings. Because when a company starts, it cannot have retained earnings. That's why we did not cancel out those ones, because those ones are post-acquisition. But in this question, this particular 5,000 is actually pre-acquisition. It's pre-acquisition. So it's the same transaction with this 40,000. So, and that's why I said we are going to include it. So we include this 30,000. So that means it gives us 5,000. In this case, there is a balance of 10,000 that is here. Apparently, we are going to cancel out this. I say cancel it out. Apparently, we are going to consolidate this 10,000 because we have canceled out 40 against 30. But the challenge now is this: what name do we want to call this 10? Can anyone give it a name for us?
Other investments.
Other
That should be
investment.
the goodwill
Goodwill. Other
that was
investment.
bought with the business, because the amount that was paid is more than the ordinary share and the retained earning.
Reasonable. But go with Femi. This is actually goodwill. And he has also explained it to us. That means because the value of the equity we acquired is 30,000, but we paid 40. That means for the parent to have paid more than that, that means the parent knows that there is something the subsidiary has that eyes cannot see, that is not asset or liabilities, but he knows they have something that can add value. And what you cannot see that can add value, we call it an intangible asset. So that type of intangible asset arising from consolidation, arising from acquisition, we usually call it goodwill. So you will find a lot of this in your exam. So that means this, our workings, we can change it to goodwill, because that means that these are our workings. It might result in goodwill in most cases. That means that if we are not paying more than the equity of the subsidiary, is it possible for us to pay lower? Yes, of course, it's possible. So there is nothing impossible. It's actually possible that we pay lower. But the lower amount, what do we then call it? Femi, can you help us with that? Let's say what we have paid is we only paid 25,000. and the equity of the subsidiary is 30, and we paid 25. What's that difference of 5? What do you call it?
Goodwill deficit.
Goodwill deficit. Why don't you just remove the goodwill and just call it deficit? But is it really a deficit to the parent? It's actually a gain to the parent. It's actually a gain to the parent because you are paying 25,000 for an equity worth 30,000. That's a gain. So you actually
Gain
call
on
it
investment.
exactly. So is that you call it gain on investment, but usually IFRS 10 says we should call it gain on bargain purchase. I think there's a question like that we're going to get to. When we get there, you will see how we're going to do it. And I will explain what we need to do in detail because we don't expect that to happen. We really don't expect gain on bargain purchase. We don't expect anybody to accept less than its equity in real life scenario. Okay. So I think we are done with this because that's the only item that we can cancel out here. So PICO, consolidated statement of financial position as at year ended when? 30th June 2017. We have our assets, we have our non-current assets. Then the first item was that investment. But when we canceled it out, we had a balance of goodwill. So I have my goodwill as 10,000. Let me remember to put my never sign. I have my goodwill of 10,000. Then my current assets, that's 50,000. Current asset is 50,000. Then I have total assets of 60,000. Then I'll have my equity and liabilities. Equity, I have my ordinary shares. So my ordinary shares for the parent is 37.5 for the subsidiary that has been cancelled out 25,000. So I have 37,500. Then this has been cancelled out. Then my retained earnings, I've already cancelled out this 5,000 as well because I said it's a pre-acquisition retained earnings. In fact, let me put it like that. Let me just, so that you know, you remember that is pre-acquisition retained earnings. Pre-acquisition retained earnings. So that means the balance of my retained earnings, which is a post-acquisition retained earnings, not post-acquisition, this is the parent retained earnings, is 22,500. And that's all. So what's the addition of the two?
PICO acquired the ordinary share of ESCO on 30th of June 2017 when the statement of financial position of each company were as follows. The non-controlling interest is measured at proportionate share of the net asset of the subsidiary. Statement of financial position as at 30th of June 2017 is as follows. You are then required to prepare the consolidated statement of financial position of PICO at 30th of June 2017.
Okay. So in this question also, we acquired the subsidiary in June, and they gave us their statement in June. Immediately, my mind goes to this retained earnings that is pre-acquisition, because it's part of what I acquired. So I would always want to remember that. And they now came up with something new, that the NCI is measured at proportionate share of subsidiaries' net assets. I would explain what that means. When I do the calculation, you will see it. But they are talking about NCI. But how many shares did I even acquire in the subsidiary? I acquired 20,000 shares. How many shares does the subsidiary have? It has 25,000. So can you get me the proportion of my holding?
80%, sir.
That's 80%. I think I should note that down since the examiner didn't tell me. So in my solution, the PICO acquired 20,000 shares all upon 25,000 shares, which is 80% in ESCO. That means NCI has 20% in ESCO. Have we noted that? I need to do my cancellation. Now I know that that cancellation would result in goodwill or gain on bargain purchase, but mostly goodwill though. Let's say these are my workings. This one up here. Let's say they're my workings one. So for my goodwill, I will have my consideration transferred. And how much is my consideration transferred? I paid 35,000. I paid 35,000. I said you should put the NCI 2 here. The way I calculate it earlier is 20% times the equity acquired. So let's get the equity acquired first. So net assets acquired in the subsidiary as the equity of the subsidiary, which comprises the ordinary shares of the subsidiary. How much is the ordinary share of the subsidiary? It has 25,000. So 25,000 plus the pre-acquisition retained earnings of the subsidiary, which I saw up there as 5,000. And remember the reason why it is pre-acquisition. I told you because we acquired the subsidiary on 30th of June, and this statement of financial position is given to me at 30th of June. That means I'm acquiring this retained earnings because this retained earnings is pre-acquisition. It's there. I met it in the books of the subsidiary. It's part of what I paid for. So it's a similar transaction with this investment. So we cancel it out. So, and that's why this is coming in. And that's the net asset I'm acquiring, this 30,000. Don't forget, this NCI, then multiply by 10,000. And that's what they mean here. The examiner is magnanimous. They were telling you how to do that. They said NCI is measured at proportionate share of the net asset of the subsidiary. That's what they mean. That you should calculate NCI by taking its share of the net asset of the subsidiary, which is 20% of 30,000. And that gives me how much?
6,000.
6,000. Then I will have a total of how much? total of 21,000. If I compare it with this one, I'll have my goodwill of 11,000. And don't let us forget that NCI should be consolidated because they are other owners of the subsidiary. And what was the value of the NCI up there? 6,000. In this case, these retained earnings, it has been cancelled out already. So it's only posts that they will be sharing. The retained earnings has been cancelled out. So there's nothing to share as far as retained earnings is concerned. So let's consolidate. So our consolidated statement of financial position as at year ended, which dates? 30th June 2017. We have assets, non-current assets. So the first item here is investment in subsidiary. After cancelling out, we had a goodwill of 11,000. So I'll have my goodwill, 11,000. Then I'll have my current assets. If I add these two together, it gives me 55,000. 55,000. Then I sum these two guys. That's my total assets. And that gives me 66,000. Then I have my equities and liabilities. What's my ordinary share capital? That will be the ordinary share capital of the parent, which is 37.5, because this 25,000 has been cancelled out. Then I have the retained earnings of the parents, which is 22.5, because this 5,000 has been cancelled out. This is a pre-acquisition retained earnings. Then the balance that belongs to outsiders, non-controlling interests, his value was 6,000. So I have total equity. How much is this? 66,000. Total equity is 66,000. I think that's clear. Please read the next question.
PICO acquired the ordinary share of ESCO on the 30th of June 2017, when the statement of the financial position of each company were as follows. The non-controlling interest is measured at full or fair value. The market price of the share of ESCO was 1 naira 30 kobo. Statement of financial position as 30th of June 2017 is as follows. You are then required to prepare the consolidated statement of financial position of PICO at 30th of June 2017.
Okay. The same cancellation. So we acquired them in 30th June. They gave us a statement as 30th June. That means this retained earnings is pre. We're going to cancel it out. And the only thing we are cancelling out here is just the investment against the equity of the subsidiary. And how many shares did we buy? We bought 20,000, and the subsidiary has 25,000 shares. I think it's the same as the previous one. That's 80%. But here I can see that they say the NCI should be measured at full fair value. So they give us the share price of the subsidiary at 130 kobo. Okay, let's see what that means. So my first workings, let me tell them that Pico acquired 20,000 over 25,000, which is 80% equity interest in ESCO, which means that NCI has 20% equity interest in ESCO. Then number 2 is my goodwill. How much did I pay for the subsidiary? I paid 35,000 for the subsidiary, and the balance will have been paid by the subsidiary, the NCI, which they have 20%. But they said I should not measure the subsidiary at proportionate share, but rather I should measure the subsidiary at full fair value. That means there are 2 ways in which you can determine the value of your NCI. I mean, I said subsidiaries, NCI. There are 2 ways you can determine the value of your NCI. Is either at proportionate share of the net asset of the subsidiary, which we did earlier, by just taking his share of the subsidiary's net assets, or you just simply measure it at fair value, which means that you will get the number of shares he has acquired in the subsidiary, then multiply it by the share price of the subsidiary. They give us the share price of the subsidiary. Then, since he has 20% and the subsidiary's total shares is 25,000 shares, so this gives us an idea of how many shares he has in the subsidiary. And they have even given us the share price of the subsidiary, which is 1.3. Let me confirm again. Yes, 1.3. So if we punch our calculator, this will give us how much?
6.5.
Sorry? 6,005?
6.5. Yeah.
Okay. So if I add these 2 together, what does it give me?
500. 41,500.
Then I will get my net asset acquired, which is the ordinary shares of the subsidiary, which I can see here is 25,000. Wait, I'll add the pre-acquisition retained earnings, which is the 5,000. If I add these 2 together, it gives me equity of 30,000. And again, the reason why the entire retained earnings of the subsidiary is pre is because we acquired the subsidiary in June 2017, and it gives us a statement of financial position as at the same date. That means this retained earnings is part of the equity that we acquired. So the difference is 11,500. Now, there's something hidden here, but I just need to mention it. There's something hidden in this goodwill here. You see, for the fact that we are measuring the NCI at fair value, if you look at it closely, you see that the NCI also will have a share of this goodwill. Ordinarily, goodwill should belong to the parents because it will have been when you cancel out what he paid against the equity, whatever balance is the parent that will have paid the excess. But when you measure at fair value, which is 6.5, you will see that if you do 20% of 30,000, that's 6,000. You see that the NCI too has paid more by 500, but nobody is asking you for that. But I mean, I just need you to see that this goodwill belongs to the parent and NCI. It's just for information purpose. It doesn't impact your calculation whatsoever. But our goodwill is 11.5. Now, having determined the goodwill as 11.5, then let's acknowledge that our non-controlling interests share its value of NCI is simply 6.5. Then now we can prepare our consolidated statement of financial position as at year ended 30th June 2017. Assets, non-current assets. So the first item here is these investments, the balance of which, when we canceled out, we had goodwill of 11.5. So goodwill 11.5. The next item is my current assets, which is 55,000. Current assets, 55,000. We have total assets, which is 66,500. And we have equities and liabilities. We have equity and liabilities. Okay, our equity, we have ordinary share capital of the parent, which is 37.5. Then retained earnings of the parent, which is 22.5. Then the non-controlling interests, which is 6.5. Then I will have my total equity and liabilities. That should give us 66,500. I'm going to stop here for tonight so that diminishing returns will not set in. We're going to continue from here. So hopefully on Saturday we would cover much more than we did very well today. We solved like 8 questions. On Saturday, I want us to solve all of these questions here. There are many, but and also we'll get to that, then solve past questions. Solve past questions. I think Yeah, so I'll also teach you intra-group transactions and all of that. Okay, good. Then we'll solve past questions, and then so that by Sunday we should start statement of profit or loss on Sunday. Then we'll move to associates. Then that will be all for this topic. But just revise it. It's a very simple concept. You will see everything we are doing is just cancellation, and that's all. You will see, that's everything we do here. It's just cancellation, canceling similar items, transactions between the parent and the subsidiary, cancel it out. Anyone you did not cancel, any balance, consolidate it. That's all. All right. Do we have any questions? Any questions?
Hello, sir. Please, I want to confirm something. So, doing the consolidation, like after for the ones that the company did not, like Pico did not acquire the 100%. So there are some parts of PPE and current assets that we sum the total amount. Are we not supposed to get the like the percentage, the proportion, and sum it? Are we supposed to sum all? I just want clarity in that area.
Okay, yeah, I get your point. That why are we not taking a proportion of that? So as soon as he has control, okay, as soon as the parent has control, he can apply the consolidation method. He can add everything together without taking a proportion like that. So the reason why our account is still balancing, is because of this NCI that we have added. You know that the remaining 25% belongs to this other guy as well. So,
Yes.
and we have already introduced him. So those assets that we added everything together, all these that we are adding everything together, so it belongs to the parents and the NCI. So the representation is already showing down here. But when we say consolidated, you don't take proportionate when you're adding the items together. You add all the items together fully. So you
Okay, sir.
don't, yeah. Okay. Thank you for that questions. So I'll see you guys next weekend. Thank you very much. Have a wonderful week. Bye.
Please
Thank
help
you,
us
sir.
drop the recording and the notes.
All right, I'll do that.
Thank you, sir.